What went wrong? We've been in this existential panic now for 50 years. What happened to our pianos? Where our watches go? How come our cars are going away? We don't have any manufacturing left. Let's just admit it. There is a problem to solve.
You're watching Silver News Daily. Subscribe for more.
Silver isn't just rising, it's screaming. And according to Jeffry, that scream is a siren wail echoing from the ruins of America's industrial backbone. While mainstream media cheers the metals rally, Tucker warns this isn't a sign of strength, it's a cry for help, a terrifying omen. As silver tears past $33 an ounce and flirts with resistance, something darker is brewing beneath the surface. Factories are closing, supply chains are disintegrating, and deep in the American heartland, the machines are going silent. What we're seeing isn't market optimism, it's panic. A flight from paper promises into hard assets. Tucker says this is how collapse begins. Not with fireworks, but with silver on fire and steel plants growing cold. So what's really driving this surge? And why might it spell doom for America's industrial engine? Stay with me, because what you're about to see will change the way you look at silver forever.
Existential panic now for 50 years. What happened to our pianos? Where our watches go? How come our cars are going away? Wait, we've got cotton. I buy our cotton. No, we're going to buy their cotton. Well, what about these clothes? No, we're going to buy that. What about our tools? Now we got better tools, and so on. It never stops, and we keep doing this decade after decade with this panic. Wait, what are we going to do? Well, there's nothing we can do. Well, what went wrong? And my point about writing about the trade deficit is that you can look at the trade deficit and see evidence of some big change. Not that the trade deficit itself is the problem, but rather it's an exhibit that reveals the underlying data problem. The problem is that the world adopted the dollar standard, the dollar became fiat, and there was an infinite demand for U.S. debt. So we had more regulations, more costs, more taxes, more higher cost of production, more unionized industries here. And they had low cost of production and an infinite demand for dollars. And then also we started making debt because now the dollar is paper, and there was no downside to just printing more and more debt, running ever more debts, and there's an infinite market for dollar-based debt assets in foreign central banks and foreign manufacturing sectors. So America has become a joke, so Biden decided to do something about it, said, all right, we're done. We're going to come up with a new industry, let's call it green energy. And we're going to manufacture solar panels and wind turbines and all become green. And then China's going to suck. Well, China's like, oh, that's funny. Get the binoculars out. What are they doing now? Oh, wind turbines and solar panels. All right, everybody get to work. Suddenly, we're completely outcompeted with green energy too. And then there's another solution. Well, the future is chips. So let's have a chip industry, but this time we're going to block the bad guys from abroad. And, there's a major problem because just like we had watches and pianos and textiles and toys and shipping and home electronics, they've always had the chip industry, and we never had one here. So we had a hell of a time, and still do, coming up with the chip industry. And then we decided we're going to lead on AI. And then that was the joke because, just last month, the Chinese programmer came up with using old NVIDIA chips, made an AI program that was a tiny, tiny, tiny fraction of the weight of anything being run by the U.S. So it's hopeless, right? I mean, we can have forever trade barriers, or we can compete and lose. That's our choice. And that's always going to be the choice so long as we don't have international clearing systems in place.
Silver's recent rally isn't just another speculative swing, it's a full-blown revolt against economic instability. After dropping to a 2-week low at $32.66, silver clawed its way back above $33. A move driven not by hype but by deep systemic fear. The metal is flashing signals from every corner of the market. Technical indicators, geopolitical tensions, and monetary policy misfires are all pointing to one thing: uncertainty. Investors are rushing into silver as the world becomes harder to read, and Tucker believes this isn't a coincidence. The Middle East is in chaos, inflation is running hotter than expected, and the Federal Reserve is hesitating on rate cuts. Silver's response? A chaotic bounce, fueled by safe haven demand and whispers of something breaking beneath the surface. The message is loud. This isn't a bullish breakout for celebration. It's a metallic warning shot across the bow of a global economy trying to keep its balance on a crumbling tightrope. And if silver is screaming, it's because the pressure is becoming unbearable. But this isn't just about global instability. Something closer to home is beginning to buckle.
Going on for 50 years, and it's strange to me that we're only now waking up to this. This all began after the collapse of the gold standard for reasons we can discuss. But in American life, it happened as follows: our costs of production were going up and up and up, and never adjusting down. And we faced a world that was increasingly open with low costs of production, low wages. And we decided to go into competition with them. And we kept wondering why we're losing. Why are we losing? America had the world's greatest watch industry between the 1830s and about the 1970s. We had all the infrastructure, all the supply chains, the markets, the reputational capital. We had everything in clocks and watches. And in just a matter of a couple of years, Japan wiped it out. I mean, it's unbelievable when you think about it. And you read the histories of, they say, well, it's because they had quartz. Well, we didn't have quartz. We couldn't, we were just like mystified. What is this quartz thing? I guess we're gonna have to give up, close everything in Connecticut. It doesn't make any sense, right? And the same thing happened with pianos. So we were the world's greatest piano makers from the 1860s all the way up until, the post-war period, really the 1970s. We had the techniques. We had acoustic pianos. We had the techniques. We had the markets. We had the skills. We had the infrastructure all in place. And then it was all wiped out. And it made no sense. But it was just simply a cost of production issue. Prices, wages were not equilibrating across countries. So other foreign countries were put in a permanent situation of having an advantage over the U.S. In ways that would never have been possible back when accounts settled. And we could talk about what that means. But anyway, then China opened up. And China saw what Japan was doing, and so targeted industry after, and then it accelerated. Then it's like an avalanche, right? So textiles, apparel, shipbuilding, tools, toys, home electronics. I mean, there was no industry that wasn't hit with this aggressive. And there's nothing wrong with competition, but it's like the U.S. had shackles and the other guy, was taking steroids, I mean, that's the way the competition was. So the U.S. and cars, of course, from Japan. I left that piece out. That's a very important piece.
As silver's price shoots upward, the cracks in America's industrial demand chains are becoming impossible to ignore. This isn't a speculative bubble inflating. It's a lifeline being pulled tighter by the second. Silver's surge is reflecting something few are willing to confront: the disintegration of operational stability in key industrial sectors. When silver spikes, it's often a signal of production acceleration, but not this time. This time, the rally is being driven by scarcity, not strength. American factories, once humming with activity, are now scrambling to secure raw materials. And silver, used in everything from circuit boards to solar arrays, is becoming harder and more expensive to obtain. The problem isn't just cost, it's availability. With geopolitical tensions rising and global trade routes under pressure, even the most routine supply orders are getting delayed, rerouted, or outright canceled. What Jeffry Tucker sees in the silver chart isn't exuberance. It's the echo of supply chains snapping. This is a market reacting to a world where production is slowing, inventories are thinning, and the very materials that power modern industry are slipping out of reach. And nowhere is this being felt more painfully than in the heart of American manufacturing.
About which I do not speak because there's too many moving parts and people quickly get bored And it's hard to even talk about it without using seemingly technical language, and people get sick of it very quickly. So it's a major problem, which is why I don't write about it, because first of all, it's a difficult thing to understand. It's taken me a few years to fully integrate all the things, the moving parts, trade theory, monetary thing. And you know what's interesting to me about this is that economists themselves, whom we revere, right, typically, oh, you're an economist, you must know what's what. There's trade economists and there's monetary economists, and they typically don't talk to each other. Well, the problem with this topic is you have to understand both in order to get the bigger picture. So that means that trade theorists don't really understand this, and monetary theorists who don't talk about trade don't really understand this. So it makes it a difficult topic even to approach from a writing point of view. So that article on Do Trade Deficits Matter was my attempt to present my analysis to a popular audience in a way that maybe people could come to understand.
The American heartland, the steel mills, the assembly plants, the industrial towns that once defined economic power are now ground zero for a silent collapse. As silver's price accelerates, it's not lifting these regions, it's exposing their wounds. Across the Midwest, factories that depend on stable silver prices for electronics, solar components, and automotive systems are facing a brutal reality. Margins are vanishing, contracts are being torn up, and operations that once thrived on reliable materials are being forced to downscale, delay, or disappear altogether. This isn't just market volatility, it's industrial suffocation. Tucker warns that the soaring cost of silver is becoming an executioner's blade for domestic manufacturers, especially the smaller firms already weakened by years of outsourcing, regulatory pressure, and labor shortages. While China rolls out stimulus packages to stoke demand and secure supply, U.S. industries are left to fend for themselves, caught between rising input costs and an economy that still demands low consumer prices. The result? A system that can't move forward and can't afford to stay where it is. Silver isn't just a commodity anymore, it's a gauge. And that gauge is warning of a manufacturing engine running on fumes.
That problem, and there's too much of it, and nobody trusts our food anywhere in the world, actually, for that very reason. So we're in a fix. We're in a real fix. So here's my point. I don't like protectionism. I don't like trade barriers. I don't like tariffs. I like free trade. But the people like me who are free traders are in denial about this problem. They pretend this is not even a big thing, you know? And it's frustrating because it is a big thing. It's a huge thing. It's been going on 50 years. We don't have any manufacturing left. Like, let's just admit it. There is a problem to solve. You might not be able to solve that by autarky and protectionism, mercantilist policies. It may not be the solution, but it's preposterous to talk as if there's no problem. And I will mention in passing another mentor of mine named Murray Rothbard, who, God rest his soul, he was a genius guy. But he was so afraid of tariffs and protectionism that he pretended like this is no big deal. He's like, yeah, so what? We get goods, they get worthless paper. Who cares? Well, it's easy to say. But when you have an economy with no manufacturing, no skills, nothing but a bunch of layabout, overclass professionals waving Harvard degrees, and that's your economy, that's not going to work.
The silver market right now is caught in a tug of war between what the charts are showing and what the real economy is screaming. Technically, silver looks poised for something big, but the deeper you dig, the more fragile that setup becomes. Let's start with the basics. Last week, silver bounced off $32.66, a level that aligned with multiple key indicators: the 61.8% Fibonacci retracement, the 20-day moving average, and the lower end of a short-term price channel. For a moment, this convergence hinted at support, sparking talk of a bullish continuation. But that bounce? It lacked conviction. Monday's close was weak, landing in the bottom third of the trading range, and that's no small detail. It shows sellers are still in control. Even the so-called rally to $33.31 didn't break out of Friday's high. In technical terms, this is a bearish consolidation masquerading as a recovery. And here's where things get more troubling. The 50-day moving average, sitting at $32 in pounds, is now acting as a gravitational pull. If silver breaks back below that $32.66 level again and stays there, the trapdoor swings open for a potential fall to $32.01 or even lower. That would destroy any short-term bullish momentum. But here's the twist. Even amid this technical uncertainty, the long-term bull trend, formed from the December low of $28.75, is still officially intact. This creates a dangerous illusion of strength. It lures in traders looking for a breakout, while the macroeconomic signals are anything but supportive. Because what's happening in the broader economy, the collapsing industrial demand, supply chain friction, trade uncertainty, isn't factored into a simple moving average. It's written between the lines. The failed breakout at 34.24 was more than just a technical rejection. It was the market's way of saying, we don't believe in this recovery. The rising wedge, the repeated resistance at the channel top, the sluggish bounce, all of it tells us that silver may be rallying, but it's doing so with a gun to its head. Tucker's warning becomes clearer here. The price action isn't clean because the foundation it's built on, America's industrial confidence, is fractured. Silver isn't climbing out of strength, it's crawling out of chaos. And soon, the ground beneath it may give way entirely.
Tremendous book. He was German, taught at Harvard. But in the 1940s, he was an architect of GATT, the General Agreement on Tariffs and Trade, and a huge proponent of free trade. And if you look at his book on international trade, which nobody does, he has about 7 chapters in there on clearing, discussing the price specie flow mechanism of David Hume and how it works, and the new system called Bretton Woods, where we had a gold standard. That gold standard did not allow for domestic convertibility, but it forced and mandated international convertibility. So when the U.S. would import goods, we'd export gold, and prices would rise in the foreign country, and then presumably they would decline in the U.S. At least there would be downward pressure on prices, and then we would become, an awesome producer and start exporting goods, and they would become the importers, right? So that's the way it works. And through this clearing system of gold shipments back and forth, you get an equilibrium established between two countries and then eventually all countries. And they had it all figured out, right? It all seemed to work. And they knew for sure that if this system ever broke down, that international trade would stop working, because an importing country where prices don't adjust downwards will be in an uncompetitive situation with the rest of the world and eventually lose all of its industry. Now, what I just said was well known and well understood by everybody. And I think even now, if you read a serious book on applied trade theory, for example, if you're studying for your, private credential, you're not going to learn this in PhD studies probably, but if you're getting your CFA or CFP or something like that, you're going to learn this. That a country can't forever become an importing country without price adjustments at home, or price adjustments abroad without losing all of its industries. So that's just it. You'll just end up like we are, with one exception, which is natural resources, right? So, if you don't have diamonds, you can't export diamonds. You've got to import diamonds. Okay, so natural resources are the one condition that is not subject, because you can make almost anything anywhere, but the one thing you can't make anywhere is natural resources. So here we are in 2025. What does the U.S. export? We export oil and we export debt. That's it. Everything else is more or less gone. Sorry, financial services and everything associated with debt. And then we export oil. We're trying to get people to buy our soybeans. Nobody wants them. Nobody wants our wheat, corn, all that crap. Right? But that's what we got surpluses of, and nobody wants them.
While American industry falters, a stark contrast is emerging across the Pacific, and it's painting a tale of two economies. In China, silver demand is roaring back to life. Recent stimulus measures, upbeat economic data, and renewed retail interest are reigniting actual physical demand. Chinese authorities aren't just stabilizing, they're pushing aggressively to reassert control over their supply chains and fuel investment. Retailers are stockpiling, manufacturing activity is recovering, and silver, with its critical role in high-tech production and renewable infrastructure, is being snapped up as a high-value asset. The optimism is visible in price action. Buyers in China are helping lift the floor under silver even as the U.S. outlook deteriorates. Now, place that against what's happening in America. There's no fiscal push, no grand manufacturing revival, and certainly no coherent industrial strategy. The heartland is shedding capacity while China is scaling up. It's an uncomfortable reality, one where the East is leaning into silver's potential while the West is struggling to even access it. And this isn't just about price differentials or demand curves. It's a reflection of strategic intent. While China prepares for long-term self-reliance and resource control, the U.S. is stumbling through another cycle of reactive policymaking, tariff threats, and monetary indecision. Jeffry Tucker's thesis hits home here. The silver market isn't just responding to investor flows, it's responding to a shift in global momentum. America, once the driver of industrial demand, is now dragging its heels. Silver's price is telling a story of energy, initiative, and intent. But it's not coming from the Rust Belt. It's coming from abroad. And for the U.S., that's not just a missed opportunity. It's a warning of who's taking the lead in the next economic cycle.
Well, so what does it mean to clear? I mean, that's really what we need to talk about, because it just sounds like it's Anglo-Saxon words, one syllable. It sounds easy, but but what does it mean, right? And there's where we need to go back. This is why I don't talk about this. You have to go back to David Hume, 17th century theorist, who was examining the problem of international trade. And he observed something really interesting. He said that a country that's importing things is a country that's importing lots of things is exporting money and importing goods. For the other country, it's exactly the opposite effect. So money is flowing from one country to the other in an exactly opposite direction of goods. So what happens, and you just have to think about it in binary sense, because David Hume was talking about this, like England and France, right? So if England's importing a ton of goods and France is selling those goods, then France is going to have an importation of money and an export of goods, and England's going to have an import of goods and an export of money. So when the money stock in some other country rises, what happens to prices? They go up, right? And what happens in a country with an export of money and therefore a diminishing money stock? Those prices go down. So this adjustment back and forth is what keeps competition on the level playing field. You see? So you have to have flexible prices in both countries, and you have to have the same money used in the settlement of accounts. And David Hume said, see, England doesn't have to worry about competition for France. Let's let France do what it does best. We'll do what we do best, and everything works out, in the long run. And that was a really interesting insight. Adam Smith took it over. David Ricardo took it up, and came up with the law of one price, the law of one wage, right? And a perfect equilibrium. All countries will have the same price and the same wage in the long run because of the settlement mechanism. David Hume called it the price specie flow mechanism. Okay. At the cocktail party, this is where people say, shut up, change the subject. Right? It's too boring. the price specie flow mechanism was in operation for hundreds of years. My mentor, Gottfried Habler, who was, I would say, one of the great economists of the interwar period, wrote a book on depressions during the Depression. It's still...
Silver's current volatility isn't just about industrial supply or geopolitical stress. It's being heavily fueled by a monetary climate that's teetering between confusion and contradiction. At the heart of it all is the U.S. dollar, which continues to lose ground even as Federal Reserve officials signal caution on rate cuts. The Fed's mixed messaging, acknowledging persistent inflation while pushing rate cut expectations further down the road, has left markets in a state of limbo. And silver, always reactive to monetary policy, is reflecting that anxiety in real time. Last week's comments from Atlanta Fed President Raphael Bostic highlighted a disturbing possibility. Inflation progress might be slower than anticipated, and the Fed's patience may outlast the markets. Meanwhile, the dollar index dropped 0.3%, marking its first loss in 4 days. Why? Because investors are starting to see that the dollar's recent strength may be less about confidence and more about desperation. Capital flight to perceived safety as the system begins to wobble. And when the dollar weakens while inflation remains sticky, silver begins to shine not as a speculative trade, but as a necessity. But it goes even deeper. Service sector data came in hot, with the S&P Global Services PMI jumping to 54.3, well above expectations. That's not supposed to happen if the economy is cooling. The disconnect between data and policy is widening, and the market doesn't know what to believe. Is inflation under control, or is it waiting to surge again? Is the Fed bluffing with its cautious stance, or are they out of bullets? In this vacuum of clarity, silver becomes the proxy, its rise and fall echoing the market's growing distrust in traditional levers of control. Jeffry Tucker sees this chaos as no accident. It's a symptom of deeper disorder in the system. When your central bank is guessing, your industrial sector is shrinking, and your dollar is losing faith, silver stops behaving like just another asset. It becomes the truth teller. And right now, it's telling us that the monetary framework designed to support economic growth is starting to betray it.
There are, I don't want to leave us here with a sense of despair that can be done about it. There are very specific things we can do about this. One is to stop the debt creation, right? So if we stop exporting U.S. debt around the world, that robs foreign central banks of the ability to use that debt as collateral to expand their own domestic manufacturing. So that's an easy solution. Like, stop running debts. That would go a long way towards at least taking away the manufacturing advantage of every country in the entire world. Okay, that they're living at our expense. So that would be one step. The second step is to lower the cost of production in those countries. So deregulate to make business easier. Get rid of payroll taxes that are a huge expense for a business. Get rid of mandates for healthcare so that businesses could, for example, just start and hire people and sell things. That would be a nice thing. So, deregulation, massive elimination of tax burdens and paperwork could, combined with the elimination of debt creation that serves as collateral for foreign manufacturing expansion, those two factors could go a very long way to solving the problem, and it might be enough, to fix it. But and I think those two things hold out a better prospect for success than just simply taxing people for importing goods. I mean, I'm not sure I buy that.
Just when the markets thought they had a grip on the chaos, another shockwave is forming, one that threatens to hit silver, industry, and global trade all at once. Donald Trump's latest tariff threat is set to drop next week, and while the specifics remain murky, the message is clear. Economic nationalism is back on the table, and with it comes a fresh round of instability for an already fragile system. For silver, this kind of policy announcement isn't just noise. It's gasoline on an already smoldering fire. Because tariffs don't just disrupt trade flows, they rip apart the global supply chains that silver relies on. If these new tariffs materialize, expect retaliations from key trade partners. We're not just talking about steel, cars, or semiconductors. We're talking about the full spectrum of industrial metals, including silver-based components. American factories will once again be caught in the crossfire, facing higher costs for imported materials, slower delivery timelines, and even more uncertainty around their long-term viability. And for silver, this means two things simultaneously. Prices could rise on scarcity, while demand drops from the very industries that would normally be driving it. It's a perfect storm of distorted signals. Tucker's warning starts to sound less like a prediction and more like a diagnosis. Trade policy, once a tool of strategic leverage, is now a wild card, thrown into a market already stretched thin by inflation, labor tightness, and global unrest. And it's not just international trade that's at risk. Domestically, these tariffs create ripple effects across consumer pricing, investment decisions, and industrial planning. Companies don't expand when costs are unpredictable. They freeze. They wait. They cut. That hesitation feeds back into silver. Investors shift toward hard assets as the system shows cracks, while the very industries that use silver begin to hesitate, contract, or collapse. And in that loop of rising prices and falling confidence, the true danger emerges, not just in numbers, but in narrative. A narrative where silver's strength becomes a symbol of economic dysfunction. And every price spike echoes the deeper question, what if the system can't fix itself anymore?
The reason why Hume's price specie flow mechanism worked was because for hundreds and hundreds of years, all currencies in all trading nations were different names for the same thing. Ultimately, we were all trading gold, silver, or whatever, mostly gold and silver, right? And some other commodity money. And that was the real money for the world was rooted in something physical, not paper, not infinite.
You had the Swiss francs; those were gold. You had the French francs; those were gold. You had the British
something you
those
can
were gold.
Yeah, it's not something you print. It's something that's real. Once that went away, settlement also went away, and that's when we got into the problems. So the long run solution to this thing is to restore a world where everybody in the world uses the same currency. How do we, which is to say gold, right? How do we get from here to there? I'm sorry, I just don't really have that answer. I don't know. But I also know that all the attempts to avoid this have not worked. So in 1985, James Baker, the Secretary of the Treasury, tried to do what was called the Plaza Accords. And the Plaza Accords were going to fix exchange rates all over the world so that you could fire up settlement again, so that there would be a fixed relationship between the dollar and the yen and the this and the that, and everybody would adhere to it. But that broke down in like 2 seconds. I mean, it didn't happen. So, but the Bretton Woods system also broke down because the U.S. was shipping out too much gold, and we're like, oh, this is not working, and because the U.S. never allowed prices to adjust downwards, inflating everything all the time, the settlement broke there too. So it's, and so that broke. So the only real solution is to go back to a gold standard of the sort that we had in the 1890s, really. But I don't know how to get from here to there. I mean, if somebody put me in charge, I'm sure I'd mess it up.
Just when the markets thought they had a grip on the chaos, another shockwave is forming, one that threatens to hit silver, industry, and global trade all at once. Donald Trump's latest tariff threat is set to drop next week, and while the specifics remain murky, the message is clear. Economic nationalism is back on the table, and with it comes a fresh round of instability for an already fragile system. For silver, this kind of policy announcement isn't just noise. It's gasoline on an already smoldering fire. Because tariffs don't just disrupt trade flows, they rip apart the global supply chains that silver relies on. If these new tariffs materialize, expect retaliations from key trade partners. We're not just talking about steel, cars, or semiconductors. We're talking about the full spectrum of industrial metals, including silver-based components. American factories will once again be caught in the crossfire, facing higher costs for imported materials, slower delivery timelines, and even more uncertainty around their long-term viability. And for silver, this means two things simultaneously. Prices could rise on scarcity, while demand drops from the very industries that would normally be driving it. It's a perfect storm of distorted signals. Tucker's warning starts to sound less like a prediction and more like a diagnosis. Trade policy, once a tool of strategic leverage, is now a wild card, thrown into a market already stretched thin by inflation, labor tightness, and global unrest. And it's not just international trade that's at risk. Domestically, these tariffs create ripple effects across consumer pricing, investment decisions, and industrial planning. Companies don't expand when costs are unpredictable. They freeze. They wait. They cut. That hesitation feeds back into silver. Investors shift toward hard assets as the system shows cracks, while the very industries that use silver begin to hesitate, contract, or collapse. And in that loop of rising prices and falling confidence, the true danger emerges, not just in numbers, but in narrative. A narrative where silver's strength becomes a symbol of economic dysfunction, and every price spike echoes the deeper question, what if the system can't fix itself anymore?
Again, this is why I don't like to talk about the subject. It's extremely important to distinguish two ways in which we talk about valuation. And they have essentially nothing to do with each other. So if I have $1, there's three things I can do with it. I can buy goods, I can buy services, or I can buy other currencies. Right? So when I talk about reducing the value of the dollar internationally, I'm not talking about domestic goods and services. I'm talking about the value of the dollar relative to other currencies when you're in the currency market. You see the difference? So we've experienced like a 25% inflation over the last 4 years. At that very time, the value of the dollar on international exchange has gone up. So down domestically, up internationally. Those are really, really different things. So the dollar's never been, except in the last 2 weeks, never been as highly valued internationally, but it's never been as low valuation domestically. So it depends on what you're buying the dollars with. You can buy a lot of foreign currencies with a dollar, but not that many eggs. And you know this in practice because I mean, the way to live, right, if you're going to say, well, how can I go about living the richest life possible? The way to live the richest life possible is to make dollars, to earn dollars, get them in your bank account, and spend them in some other foreign country, Thailand, Mexico, wherever it's going to be, because you're going to live like a king, The only place that you can't live like a king on dollars is in the United States. You see what I mean?
The deeper you look into silver's price chart, the more it begins to resemble a stress test of the entire industrial economy. At first glance, the technicals seem to offer support. $32 sits held briefly, the 50-day moving average still sits below current prices, and momentum indicators haven't fully collapsed. But peel back the surface, and you'll see something far more alarming. The failed breakout at 34.24 wasn't just a blip. It was a loud rejection of optimism. Each attempt to push higher has been met with aggressive selling, and the trading channel that once guided the bullish trend is now threatening to reverse course entirely. If silver slips below the lower boundary of that rising channel, the breakdown could be fast, sharp, and brutal. But this isn't just about lines on a chart. It's a mirror of a real-world breakdown. Factories are running lean. Inventory levels are low. New orders are flatlining. Silver, once a gauge of expansion and demand, is now being lifted not by industrial appetite, but by fear. That fear is embedded in the price action itself. We're seeing long upper wicks, closes near daily lows, and shrinking volume on green days. These are not the hallmarks of a healthy rally. These are signs of a market searching for direction in a system that's losing its own. Even the Fibonacci retracement levels, often used to spot natural support in technical trading, are becoming distorted. The 61.8% retracement at $32.12 is now uncomfortably close to the 50-day moving average, two levels that, if breached together, could trigger a cascade of algorithmic selling. These aren't just theoretical risks, they're systemic vulnerabilities. And when Tucker looks at this chart, he sees something most analysts don't: a visual representation of an industrial system being held together by sentiment rather than strength. Every failed breakout, every retest of support, every shrinking rally speaks to one thing: confidence is evaporating. The technical breakdown mirrors the economic one. And if silver loses its footing on the chart, it won't just be traders taking losses. It'll be another signal that the industrial core of America is slipping past the point of recovery.
You're going to have a serious downgrading of the risk profile, risk premium of U.S. debt before we get that kind of thing happening. And I seriously doubt that's going to happen. I don't really imagine that is going to happen. What the Trump administration seems to be doing is trying to lower the exchange rate value of the dollar relative to other currencies. So there's two things operating here. If you read the paper by the new chairman of the Council of Economic Advisors, he's a Harvard economist, and his paper that he wrote before going to work for the Trump administration on this whole subject is really, really good. And he talks about the absence of clearing and the wage differentials, especially between the U.S. and other countries, and how we can't win the struggle. So what he wants to do is use tariffs to serve as a proxy for clearing. So if we make imports vastly more expensive, then we're going to get more of on a competitive playing field. We'll reduce the trade deficit that way. So I read this article and it seems really speculative, like it's the sort of thing that works on paper, but and I appreciate the fact that he sees the problem, but whether and to what extent his solution can work in the real world is another issue entirely. A much more direct means of achieving the same thing would be to reduce the international value of the dollar relative to other countries. Like in the trade-weighted value of the dollar, it's got to be more or less the same as the euro and the yen and the yuan. That's the only way. Because it's been overvalued for a very, very long time. Since the end of the gold standard, it's just been obviously wildly overvalued. So we've got to reduce that value. It's interesting because for Trump's part, he sees the dollar as the dominant currency in the world, as a position of strength. At the same time, he's trying to bring back American industry. Okay, those are incompatible. It's just math. You can't have both.
Jeffrey Tucker's message becomes crystal clear when viewed through the lens of silver's erratic surge. We are not witnessing a healthy market response. We're watching a systemic failure unravel in real time. Silver isn't soaring because the future looks bright. It's soaring because the foundation is cracking. Tucker sees the metal as a barometer, not of opportunity, but of dysfunction. The same dysfunction that's eroding America's industrial base, gutting its manufacturing capabilities, and replacing resilient supply chains with brittle dependencies. And the most disturbing part? This shift isn't just economic, it's strategic. In Tucker's eyes, silver's movement reveals what policymakers refuse to admit: that America's industrial strength has been hollowed out by years of short-term thinking, reckless monetary policy, and relentless outsourcing. What used to be a metal of expansion, powering factories, infrastructure, and innovation, has now become a metal of retreat. It's what investors grab when they're bracing for impact. The surge in price doesn't point to progress, it points to preparation. Preparation for tariffs, for inflation, for recession, for something worse. And this isn't just a theory. It's playing out in real time. While central banks juggle interest rates and politicians juggle narratives, silver is quietly telling the truth. And that truth is terrifying. It says the system isn't adapting, it's breaking. The machines in the heartland are slowing, the charts are bending under pressure, and the old industrial engine that once defined America's dominance is sputtering, coughing, and preparing for a stall.
Good. And I don't think you make America great again by becoming an isolated, protected, mercantilist, autarkist, the internal trade zone. I mean, that's weird. It's not a sustainable model for the long run. I think Cuba tried that. It didn't work. So this is not viable. The U.S. is going to have to compete abroad. but it would be nice if we could compete with a really highly competitive domestic economy. And that's a good step. And the truth is that we got a lot of smart people in the U.S. and a lot of passion. What we lack is that thing, which is sufficient amounts of liberty to fire it up. So deregulation and tax cuts are going to be the key to making America competitive, not tariffs, I'm sorry to say. Trump has an obsession and with tariffs. And, I have tried to, I've done my best to make a case for his revenue tariff idea as a replacement for income taxes. And I think on net, that would be a good thing. But you see the contradiction. You can either use tariffs to block trade or you can use tariffs to earn money for yourself. Those are incompatible. If you want to earn money, you've got to permit more trade. If you want to protect your industry, you need less trade. Those are inconsistent. And again, it's frustrating because we're not hearing any kind of talk about this. What are the tariffs for? Are we trying to protect industry or make money?
What we're witnessing in silver isn't a rally. It's a red flag, a desperate signal flashing from the fault lines of an economy that can no longer mask its decay. Silver's surge may look like strength on the surface, but underneath, it's being driven by fear, scarcity, and systemic failure. Jeffry Tucker's warning doesn't just apply to investors. It's a call to anyone still clinging to the illusion that America's industrial core is intact. Because as silver climbs, factories fall silent. As the metal soars, the infrastructure that once consumed it crumbles. This isn't a boom, it's a final flare. The last flicker before the lights go out on a model that can't sustain itself anymore. So if you're watching silver, don't just watch the price. Watch what it's telling you. Watch the supply chains. Watch the production lines. Watch the policies and the panic. Because this metal, more than any other, is revealing the truth in plain sight. And it's not just about markets. It's about the future of an economy that was once built to last. If you found this discussion valuable, make sure to subscribe so you never miss a shift in the silver narrative. And remember, this isn't financial advice. Always speak to a licensed professional before making any investment decisions.